Hi, our topic for now is about the IRS audit report. So you or your client received the IRS audit letter with the IDR, the information document request. You prepared everything you needed to do for the audit on the classified issues, on the expenses. You went ahead with the audit and you represented the audit. And at the end, either the revenue agent, which is the field examiner, or the office examiner will prepare what we call an audit report. If you have not printed the sample income tax examination changes, the audit report that I instructed you on the website, sample report, please print. Please pause this tape now, go and print it so we can follow through with it. Okay, you have printed it, and here is what we have here. It's a form 4549, so understand the form number. And here are all the adjustments that the examiners had done on this tax year. Here depreciation, as you can see between brackets, so they have given them a credit. And then also on gross of sales, there is a credit, and there are many other adjustments. And the big one is to wages and salaries, $113,000. So total adjustment to will be $141,821. Taxable income per return was only $3,000. So corrected taxable income now will become $144,874. The tax liability is $32,978. That is on line 7. Then if you have any credits, that'll go on line 8. The balance on line 9. Advanced CIC. Then line 11 gives you the tax liability. Total tax on return was $1,072. Earned income credit, we're going to make an adjustment to that. So the deficiency now increases to $35,900. Turn to the second page. Now we go through the fees. Okay. In this particular case, the IRS revenue assessed the accuracy related penalty, code section 6662, and that would amount to $7,180. 7180 divided by 35, so it's about a 22% penalty here. Other penalties that they can assess here, a civil fraud penalty, and that would be 75%. So hopefully here the agent did not want to assess the civil fraud, just went for the accuracy related penalty, and that's usually the case, is this particular penalty. And then we have down at the bottom the tax balance due, the penalty, the interest, because interest will accumulate due date of the return, which will be April 15th, 2000XX, whatever year that is, up to the present. Then you arrive at a due or refund. Once you finish the audit, what they will do here is they will say, okay, how can you pay for this? Most of the time I'll say, go to the case, and once we receive the bill or the invoice from the IRS, we will go ahead and contact the IRS for a payment plan, or if my client can pay it, well, then we'll go ahead and pay it. Time to time, they might have a revenue officer accompany them. Therefore, they can establish a payment, or they can do a financial statement on the client or on the taxpayer, or you if you're representing yourself. And that's what it's all about here. One thing I'd like to mention is, I don't know if I've mentioned it earlier in any other tapes. Like, for example, when you're substantiating expenses to the IRS, and let's assume that for some odd reason you have a business that has a warehouse and the books and records were destroyed in a fire or a flood or whatever have you, by law you're entitled to reconstruct those expenses. One of the biggest ones that I would always encounter are people who are taking automobile business expense deductions based upon mileage. So what we will do, the best thing to do is if they have an old change receipt from the beginning of the year, one at the end of the year, we can arrive at, pretty much how many miles they drove for the year, and try to determine what the business usage versus personal usage on it, and then we'll go ahead with that. If you let's assume a meat retail outlet, and industry practice dictates that usually the goods in a meat retail outlet is 75% of the selling price. Well, then go ahead and state that into your work papers and state the fact that the taxpayer lost his books records, blah, 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 blah. And based upon industry practice, that's how much money he would have spent on cost of goods. And usually they'll go along with that. I had a case once where a lady, office examiner, she didn't want to allow me the cost of goods for the meat. Actually, this is a true story. And I said, that's fine, we can agree to the adjustment. Don't allow the cost of goods, or don't allow the income as well. Take it out. She told me, well, why? I said, because how can he be in business selling meat if he has no meat to sell? I mean, give me. So I demanded to speak to her supervisor right then and there. Supervisor on the spot said, come on, give him a break. How can he sell meat if he has no cost of goods? That with the industry practice. I hope you enjoyed this one. Happy presentation, and continue on watching the rest of the lessons that we have to offer. Thank you again.